Hi, I'm Peter Rose, founder of Longwood Currency Trading. I'd like to talk to you a little bit today about preparing for a Forex price runner. If you don't understand the value that a runner can have to your account, you really should pay attention to this, because that's where you're going to make your money, not the day-to-day stuff. You can accumulate profits over the long term, but when you get a runner, man, that's where you really want to press it and go. If you look at the statistics, most of the guys that are really successful say that 80% of their profits come from about 4% of their trades. So that says a lot. What it means is that these folks are going in, they're being very consistent and building their portfolios and moving forward with their trading, but every now and then an opportunity presents itself and boom, they go for a 5-banger or a 10-banger or something like that. And that's really where you make your money. So how do you prepare yourself for that eventuality? And that's the topic I want to talk about today, is preparing for a price runner. Now, I had a video that I did back in, this is June of 2023. So back in February of 2023, I did a video called How to Make Big Gains on a Forex Price Runner. So you might want to go back and check that out as I talk about how you actually take advantage of it. This one, we're going to discuss preparing for that Forex Runner, okay? All right, good. Cup of coffee here, and we'll get on with it. Talking about a price runner, and a dog runner incident this morning. Taking the dog for a walk, and we got him back to the house, and I just got done scrubbing moose shit off the poor dog's neck, because he had got to rolling around in the grass. We weren't paying attention. So I had him out on the deck, and I'm trying to wash him down, and I get him wet. I got it all cleaned up and everything, and it starts to rain out. So I got wet, and here I am doing a video for you guys about a price runner, and we have a dog runner today. So look, getting ready for one of these events, it isn't something that happens that often, but when it does, it's a big movement, and you never know that it's going to happen. So your trading has to be fairly consistent with not the expectation of having the runner there. What does that mean? It means that you're not trading to make $5,000–10,000 a year. You're trading to make $50,000, $60,000, $200,000 a year, something like that. And so you can't afford to be taking your whole account and risking it at open and hoping that the thing is going to just tear ass off. Remember, whatever you enter a trade with, when you lose, it's your stop. You're going to lose that. So if you're trading a 10 lot and you go in with a 10 lot and you have a 10 pip stop, you're going to lose $1,000 every time. So again, I talk a lot about win-to-loss ratio and stuff, and so that's really a critical issue, is all those things that I've talked about in the past. So if you're trading a 10 lot, do you want to risk the probability? If you're a day trader, again, we're talking about day traders. So these are concerns that day traders have, maybe not such if you're a long-term position trader, because you're looking for the long run. You're hoping that that's what's going to happen. But as a day trader, we're trying to close things down after a couple of hours so we can go get to work or do whatever we want to do, or to trade for a half an hour. So you don't want to be taking the risk of your whole account until you're really well into the profit and moving toward that profit target, so you can set your stop if it falls back. At least you make a decent wage for the day. So if you're trading a 10 lot, you might not want to go in and take a 1,000 pip loss right off the bat. So you might enter with a 3 lot or maybe a 5 lot or something like that. See what happens. Because if you lose on the 3 lot, okay, you lose $300. You can do that a couple of times during the 2-hour period that you have. It doesn't work out. You've lost $600, $800, $900 for the day because you tried it 3 times and you go off to work. Try it again tomorrow. It's not been crippling. You haven't lost $3,000 by those 3 losses and taking a 10 pip loss on a 10 lot full in. What are you ultimately trying to do? You're trying to trade on a daily basis so that you can make enough on a daily basis that's going to count in the long run. If you can make $300 5 days a week, that's $72,000 a year. So $300 a day, that's relatively straightforward if you have a large enough account where you're running, you got a 10 lot. You don't have to get very many pips to get $300. But it'd be nice to get, well, if your expectation is you're going to make an average win value of over the long term of 300 or 10 pips, 15 pips. I don't know where your skills and capability lie, but let's just pick 10 pips. You're gonna get 10 pips on average when you make that win. So on a 10 lot at $100 a pip, right? 10 times 100, you get 1,000. You make $1,000 for the day. So that's pretty good. But if you're running with that much money, I mean, $1,000 on a $100,000 account, because I make $10,000 for every lot that I've got in there, so I get $100,000. I make $1,000. That's pretty good money. It's 1%. Is your expectation greater for that? Well, I don't think you ought to be too greedy about it. I think that's a pretty good day's wage. Look, you make $1,000 a day, 4 days a week. You're making a lot of money. The problem is taking the losses. The other problem is what happens if you get that runner and it goes. If you're a day trader, this is where you put limit orders in and set and forget with a trailing stop. Or maybe you just take the day off and say, geez, I'm making every pip that this thing goes up beyond where my profit target is. If I let it run, I'm making $100 a pip, or I'm making $200 or $300 a pip. So that money is going to mount up. What happens if that thing then takes off and runs away on you, and you're not going to be there? How do you prepare for that? That's the thing that I'm talking about. It's easy to prepare for a runner if you're sitting there all frickin' day long, or you, I mean, I don't know. You could be doing a runner, it could run for weeks. So if you're not going to be there and you have to get to work, how do we prepare for this kind of thing? This is the scenario that we're looking at, and I'm sorry the board is so crappy because of I'm not a Spielberg here running this thing off. So you get price and it's doing this, and you're up to here, and so maybe you've figured something out and you enter here. Okay, that's your enter. Enter for the trade. You set your stop somewhere in here, and things have gone up. You've moved your stop to break even. Life is good. Here's your profit target. That's what you were hoping for to get for the day. And you see that as this thing gets up there, it's got a lot of momentum. Okay, so this somehow indicates momentum. And you decide you're going to stay with that price as it moves up toward the profit target. So you're going to want to have been at this point building. You might build your position here, and then from this point up you may be staging. And I've done videos on the difference between building a position and staging a position, so I'm not going to bore you with all the mechanics of all that. But let's say you're trading 10 lot. That's your bank. In the building phase, you want to make a decent day's wage regardless of what happens with the rest of your day. $300, $500 a day. If you're doing that and if you do that 5 days a week, that's 100 grand a year. So you have to look at this building stage here as to how many lots you need to get in so that you can set your trailing stop to a point where you're going to, at least with all the stuff that you add in, you'll make at least $500 for the day. But you want to take into consideration what's going to happen as this thing shoots off. You're not going to be there in this whole period of time. You're gone. But you are going to be active in here. So as you're doing that, do you need to put in 10 lots in here? You don't necessarily need to do that, because again, if you do that and you get stopped out, if you go in with 10 lots and you get stopped, you lose $1,000. What's good? $300. You don't mind losing $300. You're not going to lose that every day. It's not going to be $72,000 a year that you're going to lose. You're going to lose $300. If you're a 60-40 trader, you lose it $300 4 times, and you win whatever you're going to win, $500 6 times, and the numbers are really good for you. So this build stage, you want to ensure yourself that you make at least the $500. But you don't want to lose very much, because if you get stopped out, you've got this 2-hour period or an hour period where you're going to be there trading. You want to get done with the day. Maybe the one trade isn't enough. You think this is going to work out. So you've got a situation where price has done this, it's gone up here, and you've gone in, it's crashed and burned, you're out. It's gone back up to here, and it's crashed and burned, and you've gone out. And now it goes. So you want to be there for the turn, call that the turn. You want to be there for the turns. So within this period of time, if you're on a 5-minute chart, you have 12 candles, 12 5-minute candles an hour to make a trading decision. So within an hour, you've gone through all this crap, and now you're in a position where your entry is stuck and you're on the way. So by entering the trade, you've entered that with, say, 3 lots, and then as it's gone, continue to go up further, you've built with another 3 lots, or maybe you're going to add in 5. I wouldn't suggest adding in your building stage more than what your initial entry level was, because if it goes against you, then you end up negative for the position, and there's no need to do that. If you build your position at the right place with the right amount of lots, then you can set your stops so that you lose very little, or you make a very small gain. You might not make that $300 for the day, or $500 that you're trying to get, but you're not going to lose anything. The idea is that if this building crap that you're doing is okay, and you get here to the profit target, what happens from there? You got to go to work. You planned on being there to this point, to the profit target. That was your trading time allowance based on the momentum of the price, right? And now this thing has gone past that profit target, and you're sitting there with it, and you're going to go, this thing is really going to go. So here is where you want to have some dry powder. Maybe you went in with 3 and you've added 1. Now you're up here at the profit target, so you've got 4 lots of your 10 that you've put in. What happens if you put 6 lots in here? Where's your average price, and can you set a stop there so that if it goes against you, you don't lose any money? However, if the thing continues to go, you can then trail the stop behind it, and now you've got your full load working for you. Yes, you missed whatever the profit target is, 20 pips. You've gained, say you went in with 3 and then build with 1. You've got 4 lots with a 20 pip profit target. You added 6 more at the profit target, 20 lots up. Your average price is going to be dragged probably more than half the distance between those two, right? Because you're averaging out. I don't know what that number would be. Figure it out and determine where your stop is going to need to be so that you can set it and forget it and let this thing go as far as it's going to go. Your decision, the only decision to make, is you have to have a rule that says where do you set your trailing stop. Stop. Sorry, my brain is still on wrestling with the dog and getting the moose shit off him. Where do you set that trailing stop? That's the only other thing that you got to concern yourself with. But you need to prepare for this, even if you're not trading 10 lots, even if you're trading 5 lots. You may not want to risk that 5 lots on that opening move. I talk about this in the course that I have in Advanced Solutions, and until you get to the point, in my opinion, you're trading 8 to 10 lots, you shouldn't be building or whatever. You should be all in, all out. If you're not willing to take a 5 full lot stop risk at 10 pips, $500, you haven't really built up enough confidence in your trading in order to make any of this stuff that I talk about work. So you really need to go back and reanalyze the stuff that you do know, so that you can have the confidence to be an all-in, all-out trader until you get up around 8 or 10 pips, where it makes sense to break the position up into a building stage and a staging phase. And then you have to, and I cover this in Advanced Solutions and consulting that I do, what's the math for balancing the building and the staging out so that you don't lose any money. You might not make as much money as the bulk of the position you've put on. You may have 20 lots into this position and the thing collapses, and you would have had maybe let's see, 20 lots, you'd be $200 a pip. You're 8 pips up, 208, you're 16,000 up, and the thing starts to collapse on you. And what do you need to end up with? Well, you'd like to end up with $500 for the day. And so you have to mathematically figure out how to put all this stuff together and where your stop is so that you end up with $500 for the day, because that would make it a regular trading day, right? The issue that you're concerned with, again, is protecting or locking in a certain dollar value that says, yeah, I was here. But that dollar value for the money that you're messing with down here is a good percentage return. You make $500 on 5 full lots or something, you're making 1%. That's really good. But if you're making $500 on a 200 lot position that you've staged in, a 20 lot position that you've staged in on a $200,000 bank at $10,000 a lot, and so if you divide your $500 by the $200,000 that you've put at risk in this whole position, and then it collapses on you, the $500 divided by the $200,000 isn't a very good return against your money that you risk. But that's okay, because you made the amount of money that you would normally expect to make down here, and this kind of thing is only going to happen maybe 4 times a year. The fact that you had to go off to work and you weren't here to manage this maybe properly is okay. You'll catch the next one. So you have to build this. You have to look at the mathematics of it. I understand most folks aren't interested in math, or they don't know how to put things together mathematically. But that's how you solve a problem. You want to know how far your cannonball is going to go when you shoot the cannon? You've got to have mathematics behind that in order to figure that out. Despite the fact you have no interest in the math and you love shooting a cannon, you better understand the math. You can love trading and making all the money that you get from there, but you better understand some of the basic math that's involved: win-loss ratios, average winning values, per trade expectation value, and return against risk, and how you balance the building and the staging stages of all these things so you don't get your ass handed to you if things go south. And if things go in your favor, you've done the math so that you maximize that profit and you get a 5-banger or you get a 10-banger when you've got a runner. And that's preparing for a Forex price runner. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day. And I'm going to go wash the bow dog off, wash some more moose shit off of the bow dog. That's what I got to do for the day. Cup of coffee first. Thanks for watching.